So our topic today is about the Paycheck Protection Loan. You got funded, now what? We're very pleased to welcome back David Doolin, who will be introduced in just a moment. But meanwhile, we wanted to give you a little background about ourselves and this series of coffee chats. I'm Nicole Lezin, one of the co-facilitators of a local initiative called CORE that I'll describe more in just a moment. And I'd like to introduce
Nicole Young, the other consultant.
And the other Nicole. So welcome everyone. For those of you who are new to the idea of CORE, it's an acronym that stands for the Collective of Results and Evidence-Based Investments. It's a local initiative that evolved from a funding model to be more of a movement to achieve equitable health and well-being in our county using a results-based collective impact approach that is more responsive to community needs. And we'll put up a link for those of you who might be interested in learning more about CORE. There's a lot of effort and material information about our guiding steering committee and some of the events and trainings we've held. But for now, we just wanted to give you an overview of the CORE process and where we've landed through these coffee chats. So next slide. We developed, with the input of many people in the community over the last couple of years, a mission and vision statement that you see here. And both of these have equity at the center. And by that we mean that no one's outcomes should be predicted by their socioeconomic status, their race, their sexual orientation, their ethnicity, their geographic location in the county. It really means that we all have an equal opportunity to benefit from living in this wonderful place. Next slide. So to do that, we developed these core conditions of health and well-being that you see here. And these are just ways to capture the areas of opportunity to have health and well-being in our daily lives. Again, you see equity at the center. Some people might work more in one of these sectors than another, but the important part of this are the dots that connect all these to one another. So for example, you're unlikely to have health and wellness if you don't also have economic security and mobility, or some of these other features. So CORE is really about trying to align all of these efforts to yield better and more sustainable results across all of these areas for all of the residents of our county. Next slide. Oops. We're not ending yet. So with that, I'll just say that if you want to learn more about CORE, we are happy to share more information. But the CORE initiative is part of what has led to the umbrella for the training that is offered through these coffee chats and some other webinars and events that used to be live and have transitioned to these weekly chats and other virtual capacity building kinds of efforts. So we're very pleased to continue those today. And I'll turn this over to Nicole Young, who will introduce our guest today.
Thank you, Nicole. And we're so pleased to have David Doolin back with us today. This is David's third time presenting at a coffee chat for us over the last couple of months. And as he'll tell you today, a lot keeps changing. And so we're grateful that he keeps agreeing to come back and share updates with us and with the nonprofit community and today the business community on, first we heard from him about how to access payroll protection loan funds and the economic injury disaster loans through the CARES Act. And then more recently, as new information has been coming out about how to make sure that you are maximizing the amount of loan forgiveness. David's been, again, sharing tips and tools with different organizations and businesses that have these different loans. And so David is a local CPA, and he's the managing partner of Petrinovich, Pugh and Company. He's also the board president for the Community Foundation of Santa Cruz County, which is how we first got connected to him through Susan True at the Community Foundation. So grateful again for his time, for his expertise. And so David, I will turn it over to you to lead us through your presentation today.
Good morning. So nice to be able to be with you guys again. And I just want to throw out another shout out to the two Nicoles. I just love that two young people are, making a living by creating change and positive good in our community. And it's just awesome to see. And thank you for inviting me back. Also, it's nice to see some familiar and new faces on the screen. So I look forward to chatting with you all today. Next slide, please. So this has never been more appropriate than right now. Last Friday, the SBA issued a third set of interim final guidance. And as we know, interim final guidance changes all the time. It's neither final, it's certainly interim. It was directly related to what they issued the week before, which was an application for loan forgiveness, which is an incredibly onerous form that really needed a lot of guidance. The good news is that the guidance that they provided answered in a very positive way a lot of the questions that we had in the previous presentations that we talked about forgiveness. So we're going to spend a lot of time talking about that today. This information is changing. We don't have all the answers, but we have a lot of the answers. And next slide, please. Today, my presentation is going to give a general overview. We're going to talk about maximizing forgiveness. We're going to talk about the reductions in forgiveness due to a couple of things. And then we're going to talk a little bit more about documentation. A lot of the documentation requirements have been added with the loan forgiveness application, and there's a whole section on documents in the loan forgiveness application. We don't have time in this seminar to go through that in great detail, but I can tell you that I know your banks are working on gathering more specific details that they'll be offering you. And I'm sure that both your banks and us and others, of course, will be giving seminars that are just generally directed around how do we fill out this form. So let's move, please. Our general overview and our big requirement, and we're still waiting for more softening on this, but I'm still saying that at least 75% of the loan must be used for payroll, health insurance, and pension contributions. That does not mean you're going to lose 100% of your forgiveness. What that means is that what you should be doing is, even if you can't spend the money in the forgiveness period, be sure to spend at least 75% of the proceeds you get on payroll, health insurance, and pension contributions. That's my recommendation. It's not 100% written in stone, but in reading the act and in reading the guidance that I've seen so far, nothing's changed my mind to say that you shouldn't do that. As you know, or many of you know, Congress is still looking at extending the forgiveness period from the 8 weeks that we have now. We hope that that happens, especially for those businesses that were, during the shelter in place, required to shut down, at least partially or fully. Those that got the loan and are sitting there trying to figure out what to do with the money would greatly benefit by another 8 weeks or maybe 12 weeks. They're talking about, I've seen 16 weeks in a proposal, I've seen 24 weeks in a proposal, and we'll see where that goes. I just very much hope that happens. The second thing is that your bankers, your gatekeeper, I've said this every time, it was on the, in the getting the loan and now in the forgiveness part of it, your banks are going to be the ones you'll be working with to make sure that you maximize your forgiveness and that you provide the documentation that they need. And no place has that been more true than in reading the forgiveness application and And in looking at the interim guidance that just came out last Friday, it's very clear that it's the bank's responsibility to work with you and to make sure that the information is adequate. Most of all loans over $2 million will be audited by the SBA directly. Loans under $2 million, what happens is the application will be submitted to your bank. Your bank has 60 days to review it and approve it. They turn it over to the SBA, and the SBA has 90 days to fund them the amount of forgiveness. And then they have a period of time after that that they can audit that and decide, well, no, we did the wrong thing or the right thing, and that directly affects your bank and you. So ultimately, I think, and there's so many loans out there, that the SBA is going to review very few loans under $2 million. I think working with your banker and making sure that you guys are in agreement is never more important than now. Next slide, please. Okay, so let's get right to it. The forgiveness is based upon amount spent on eligible payroll and other expenses in the 8-week period, or what's now called the alternative covered period. Now this has changed significantly or been softened significantly with the guidance that was issued last week. First of all, we had this issue that said, and it's in number 3, it says amounts that were paid and incurred during the period. And we're always concerned, is that both? Does it need to be paid and incurred? Is it cash basis or is it accrual basis? What it turns out is that they've sort of made it as flexible as they possibly can make it. If you pay, if the first payroll period happens inside the 8-week period, let's say you fund on the 1st of the month, and on the 3rd of the month, you pay the payroll. And it's for, a large part of it's for the period before the actual 8-week period. What they're saying is that's included. That amount is included in forgiveness. And then as you get towards the end of the period, what they say is, let's say that your final payroll actually is after the end of the 8-week period, but you have some portion of that time that falls within the 8-week period. Now their guidance says, well, you can pay that in the ordinary course of your business, but the portion that relates to the 8-week period is part of the forgiveness calculation. So that's very important, and it's actually pretty flexible. So you've been given this opportunity. In addition, what they said is if your payroll is biweekly or more frequent, so that does not include people who pay twice a month or people who pay monthly, but it does include biweekly or more frequent, you can choose what's called the alternative covered period. And the alternative covered period essentially says the first payroll starting after the funding date can start this alternative covered period for your 8-week calculation, which gives you a greater deal of flexibility if you're paying every other week. Sometimes there's weird payrolls, it's not the 15th and 30th, and you have a little more flexibility in determining how you include that payroll in the forgiveness period. They also did come out and say that the 8-week period really is 56 days. So it's not 8 working, it's not working weeks. It doesn't start in the, it can start in the middle of the week and it can end in the middle of the week. And that's very important. We didn't know that until last weekend. Next page. So the 75% expenditures must be payroll. Now this is a different 75% than I said originally. all of your funds, 75% of which should be spent on payroll. This is directly for the forgiveness calculation, and we're going to call these the 75% expenditures. They are payroll, state employer taxes, pension contributions, and health insurance. If you choose the alternative covered period, you need to line up your state employer taxes, your pension contributions, and your health insurance with that alternative period. Payroll, they really intentionally, I think, liberalized the payroll calculations. They did tell us this time that you can include bonuses. The only limits on the bonuses are on the amounts that are paid to owners, and I'll talk to that in a minute. They didn't do a great job of defining what an owner is, but in private companies, you can pretty much assume that if it's an S corporation that's 100% owned by an individual or substantially owned by an individual, that would be considered an owner for the purpose of this calculation. And I believe they'll probably extend that to family members. So we'll get to that in a minute, but payroll does include wages, tips, other forms of compensation. Somebody asked a pre-question about parsonages for clerics, and you know, there's no specific ruling on that, but in reading the way that I read the guidance that they gave last week, they're being very liberal on inclusion. So I would definitely include that in the calculation. In terms of the maximum amount, it would be the annualized amount that a person making $100,000 a year would make. And the amount that I show there is $83.33 per month. That was lowered a little bit by a calculation in the guidance. It's around $15,100 for the whole 8-week period now. It's slightly less, but the bottom line is that if you have a person making less than $100,000 and you want to incent them to come back to work and pay hazard pay or a bonus or anything like that, as long as you don't reach that cap during that period of time, that amount will be forgivable. The limitation on owners is essentially, it looks back to last year and it says, what was the salary that you paid to the owners last year? And if that exceeded $100,000, then you have that $100,000 limitation. But if it was less than $100,000, the limit's going to be the amount paid for last year. And that's an unfortunate conclusion, but it's one of the outcomes. So to give you an example, if the owner received of an S corp received $50,000 in compensation in the previous year, if you take the $50,000 divided by 52 times 8, that's going to be the limitation that you can use in the forgiveness period. So what this prevents is for owners that weren't taking a salary in the past to increase their salary during the forgiveness period and have that forgiven. State employer taxes, again, are very small. Pension contributions, it's pretty liberal as well. It says any pension contribution. And then health insurance is group health insurance. The 25% expenditures, again, rent, mortgage interest, utilities, internet and telephone, and gasoline for transportation vehicles. All those things, again, we got some pretty liberal guidance on how to include those. I mean, you've got the 25% limitation, but they were very clear in there that, for instance, if you funded on the 25th of the month and you pay your rent on the 1st, that's includable, and then you pay your rent on the 1st of the next month, that's includable. And then you pay your rent on the first of the following month. 25 days of that falls into the 8-week period would be includable as well, even though you don't pay it till the first of the month. You don't have to prepay or anything like that. So that's a good outcome. What you can't do is prepay rent for periods down the line. But if you pay your internet and telephone and utilities and rent in the ordinary course of business, you may be able to get more than 2 months worth of each, depending upon the timing of your payment. And so including periods from before the 8-week period started. Of course, you have the 25% cap, and you can't prepay. Next slide. Okay, this is where things get a little bit, actually we got some good guidance on this, which is helpful. And if you look at the application in detail, there's some guidance on this as well. But there are reductions to the forgiveness based upon reductions in pay rate for employees and in FTE reductions during various periods of time. The one thing that's clear is that, and frankly, they added a lot of detail on this, but if you have employees that you reduce their pay between February 15th and April 26th by more than 25%, but you restore them to their previous pay at June 30th, then you can, or the same thing with your FTE reductions, then you can throw yourself out of this reduction calculation and just meet this safe harbor, which allows you not to have to worry about further reductions. And that was a big change, and I was actually a little surprised by that. But it's really, okay, you're looking, that's your first step, is look at where you are, and if your 8-week period closes before June 30th, it may take you a little bit longer to file that application if you had a situation where your full-time equivalents or your wage rates dropped. So you need to pay attention to that. You may just not file your application until sometime in July. The other thing is that they wanted to make it very clear, and we thought this was the case, but they don't want double dipping. So a salary reduction is different than an FTE reduction. And they're two different calculations. So if someone's pay went down because they're working less hours, that is not included in the salary reduction. That's just included in the FTE reduction if you're paying them at the same rate. But if you're paying them at a lower rate, but they're working the same hours, then that's considered part of the pay reduction. Okay. So let's talk a little bit about the pay reduction. And actually they have a real calculation on a worksheet that goes in the forgiveness application that has you take those employees that are making less than $100,000 a year and compare your pay rate for them before the 8-week period and in the previous period last year and in this 8-week forgiveness period. And if that calculation shows that their pay rate was reduced by more than 25%, then you're going to have a dollar amount reduced from your forgiveness. It's not a percentage calculation, it's actually a dollar amount that you calculate the dollars that you paid your employees less than that 25% reduction, and that amount is reduced from your forgiveness. We're going to have an example of this a little bit later that hopefully clarifies a little bit. Then there is the FTE reductions. And there are really 4 important considerations for calculating the full-time equivalents. And that is, first, one thing that they did conclude in the guidance that came out last week was that the full-time equivalence is based upon a 40-hour work week. Now, if you calculate all these periods consistently based upon a 40-hour work week, you'll come up with the same ratios. It's not going to change anything, but it's very clear. It's not based on a 30-hour work week. It's based on a 40-hour work. They even said they considered a 30-hour work week, but they changed it. And if you work more than 30 hours in a particular week, it's capped at work more than 40 hours in a particular week. It's capped at the 40 hours. So what you do is in each of these periods of time, the first thing you do is you look at June 30th, 2020 versus, oh, there's a typo in there. That is, no, that is right, February 15th, 2020. And if the amount of FTE has been restored to the amount at February 15th, 2020, as of June 30th, none of the other calculations matter. You're going to get 100% forgiveness. You will not have a reduction because of FTE. If that is not the case, then you go to these other calculations, and what they do is you can choose either one of these periods, and you determine your average full-time equivalents based on an employee by employee basis. And if they're working 30 out of 40 hours, you can choose to use 0.75, just do the math. Or you can choose to say anybody under 40 hours is 0.5 and everybody at or above 40 hours is 1, whichever works to your favor, but those are your two methods of calculating. And you calculate the average over those periods of time. And for a salaried employee, presumably they're based on a 40-hour work week. In our firm, we have some salaried employees that take a reduced pay for reduced hours, and those people are considered less than full-time equivalents, and we'll have to do the math on that. But that's the way the calculation is done. And then you compare your 8-week, during your 8-week forgiveness period to these other two periods, and there's a percentage. If there's a reduction in the FTE of 10% versus the 8-week forgiveness period, then your forgiveness will be reduced by 10%. This is an extremely challenging calculation, and it's made more challenging by the form itself. And like I said, there's going to be a lot of conversation. Hopefully you have it with your banker. And in addition to, if you have bookkeepers, I know that they're going to be working on this. I think there are some bookkeepers on the call today. I think you're educating your clients on how to do this calculation. You're getting up to speed on this calculation is going to be very important. Next slide, please. So, as we've talked before, we are saying that the best practice when you get your payroll protection loan is to put it into a separate account and spend out of that account like it's like you're reimbursing an employee. Like submit an expense report and reimburse that expense report out of that separate bank account, and be very clear and separate. What I don't want to have happen is that my clients go out and buy a truck or buy inventory and have that get mixed into this bank account. You can do that through accounting, sure, but it's just easier to have the separate bank account and just a very clear and direct connection between the payment and what you're spending it on. what we're doing and suggesting other people do is, as you pay some funds out of that account, then take a detailed copy of exactly what you're paying, whether it's your utilities or your rent, or for payroll, a detailed copy of that payroll run, and detail, I mean by employee, so that we can have verification that you didn't exceed the $100,000 limit during that period of time, and have that ready for when you fill out the application form. And the application form, especially on payroll, has a lot of detail that you need to fill out. So the more detail you have as you're going through this, the better for filling out the application. The final thing, and I just because it's just too much to include in today's webinar, I'm saying attach all the detail as referenced in the loan forgiveness application, and there is a full section on documentation that you can go through, and all of that should be in there. So from there, I want to go to a number of examples that we have that hopefully will clarify some of the things that that we talked about today. And Nicole's, if you're the last program that we had, there were a number of frequently asked questions that we had answers to. Feel free to provide them to the people today. Some of the information in there may have changed given the further guidance that we've gotten, but at least it'll answer maybe some of your questions. What we did here, and this worksheet is available to you if you'd like it. I did a basic pass at this, and then Nicole went through and made it really pretty for everybody, which I think is awesome. So we have an example here that you see that at the very beginning of the period, they got $150,000 payroll protection loan. In the next week, in week 1, they paid $25,000 in payroll. Week 3, they paid $25,000, and all the way through at the end of the 8 weeks, they paid $25,000 for a total of $100,000. Now here in the example, if you see the $25,000 in week 1, part of that may relate to a period prior to week 1. That doesn't matter. We know now that that is includable in the forgiveness calculation. Also, if you get to week 8, that $25,000, in fact, that $25,000 could be paid the following week. And if it relates to if it was incurred or earned by those employees during the 8-week recovery period, then that $25,000 gets included. Some important things in this calculation, if you look at the right-hand corner, there is the percentage of the loan that was used to pay for each of those items. And the key factors, you can see 78% was included for payroll and payroll-related items. So that means, and if you look at the calculation, if you take the $150,000, or excuse me, the $121,000 and divide by 0.786, you can see that math exceeds the $150,000. So there's no reduction of the forgiveness of this loan due to the requirement that you pay 75% during the forgiveness period for salaries. Moving on, you can see I have some examples here of rent and utilities and internet service, and that is less than 25%. So based upon all of that, plus the fact that if you look at the very end of the the usage period, they've used $155,000. That, in this very simplistic calculation, and assuming there are no changes, no reductions in wages, and no changes in FTE, that this loan would fully be forgiven. If we move to the next example. So we have what we did here is we just took out the $25,000 in week one. And if you look at that, the total amount of salary paid during the forgiveness period is now $96,000. And based upon that, if you take $96,000 divided by 0.75, you can see that only a max of $128,000 is now forgivable because they didn't use the $175,000, or they didn't use 75% for payroll. So that's the first area of reduction if you don't use 75% for payroll. This again assumes no reduction in wages and no reduction in FTE. They just weren't able to get it all paid. This is a great situation where somebody may decide that their employees deserve some hazard pay for the period of time that they were working here, or some sort of a bonus. If they pay the bonus to the right people, primarily those making less than $100,000, even with the bonus on an annual rate, then that could increase them to 75% and increase the amount of forgiveness. And then moving to the next one. In the next one, we had, we just did a calculation, again, carrying forward that 73%. So our maximum forgiveness is now $128,000. But we reduced the pay to our employees who are making less than $100,000 by more than 25%, and the dollar amount that we reduced to them was $25,000 in this case. So now our forgiveness calculation takes us from $128,000 down to $103,000. In addition, very simply, we decided that we, based upon comparison, first of all, we looked at February 15th to June 30th, and we found that our FTE had, in fact, gone down. And then we went to our calculations of the averages for 2019 and 2020, and we found out that the best situation we had was the first part of 2020. To the 8-week period, we had a 20% reduction in our full-time equivalent. And when that happened, that further reduced our forgiveness to a point of $82,000. So you can see it's very simplistic in the calculations, and as I said, the calculations themselves are challenging, but you can sort of see that even though you are, even though you have the loan and you use it for the right purposes, and in this case where we're looking at the 73%, again, I told you when we started that I would take some of what was left, or actually all of what was left, and if you look down below, there's $20,000 left that we haven't used, and I would use that for payroll in a period outside of the 8-week period. Even though it's not forgiven, I want to make sure that you get up to that 75% for all uses of that $150,000. Now, the good thing about that is if Congress acts hopefully quickly and the president signs it and they expand the 8-week period to a period of 16 or more weeks, then obviously we have much greater opportunity to hit that 75% or even more, and reduce any loss of forgiveness that we would have. And I think that's pretty. I know everyone's head is swimming now because they have for all of these chats we've had, but I will open it up for questions now, and I know that there have been some coming in. So Nicole, you want to?
Sure, David, thanks. So we had a question from Tony Balistreri about the incurred or paid relating to the alternative period, meaning whether or not that could be included in an additional payroll. So Tony, I don't know if you want to unmute yourself and ask David the more detailed version of your question, or if that got answered through some of the presentation.
Hi, can you hear me?
Yes, go right ahead.
Okay. So my question is, they're talking about that accrual that incurred or paid using the current period, using the method before the alternative. But on the alternative period, if you pay a payroll, let's say you have a biweekly payroll and you pay it the following Friday. In that first 2 weeks, can you include the payroll that was incurred plus the payroll that was paid? So in other words, you'll be able to include, instead of 4 biweekly payrolls, 5 biweekly payrolls?
Well, the way that it works, and I think it's the same for the alternative covered period as the regular, is if it's paid and it's been incurred in the past, then it's includable. So that would be included. And it's not fully clear but all the examples that I've seen show that. And then when you get to the end of the period, even though you haven't paid it, if they've incurred the payroll in the normal course of business outside of the 8-week alternative period, you can still pay that and have it be included. So it's possible to get a little bit more.
And David, Robin had a question.
Say that again. I'm sorry. What was the last part you said? I'm sorry.
So I'm saying it's possible to potentially get more than 4 periods.
Yeah. So it's better. It's really better if someone has a biweekly payroll. It's pretty much always better to use the alternative method, it seems like.
Well, maybe.
So you get a whole payroll.
You can't. I mean, it may be. You just have to look at the calculation.
Okay. Thanks, David and Tony. I'm going to try to get a couple more questions in here in our remaining time. Robin had a question about automatic credit card payments that include PPP loan forgivable expenses coming out of another checking account. Can you do a reimbursement out of a PPP loan account for that? And Robin, feel free to unmute yourself and chime in if I haven't captured your question correctly.
No, that's correct, Nicole. I'm just curious because one of my clients has several payments that are made through a credit card but are coming out of a separate account from the account that we've set up for the PPP loan. So
I would just reimburse that account and take a copy of the credit card bill and any other bill that you get from the person submitting it to the credit card, and just put that in a file and put that as part of your documentation.
Okay, great. Thank you.
Thanks, David and Robin. Taylor had a question about state ER taxes. Taylor, do you want to provide any more details about your question?
Yes, thank you. Hi, everybody. Just curious, you can include any employer taxes that are paid to the state, correct?
That's correct. So it's really, and the problem with that is it's not very much. It's your SUI and your SUDA. So generally by this time of year, most of that's gone, but it is includable.
Okay, great. Thank you.
And Thomas had a question about an employee who resigned and received accrued PTO with his final paycheck. Can they claim the PTO payout?
Yeah, no, I mean, that's clearly in the definition of payroll is included. And there's also, just to sort of carry on with that, when you're doing your FTE calculations, they gave us a lot of breadth in terms of, you know, a lot of companies are having difficulty getting employees back because it's been, you know, they've increased the amounts of benefits for unemployment now. So if you make a bona fide offer to an employee to bring them back, and you submit a letter to them, unfortunately, you have to also submit that to the state as well, but and tell them that you know, ask them to come back. That does not hurt you in your FTE calculation. Also, if someone leaves voluntarily during the period of time of the 8-week period, or you fire them for cause during the 8-week period, that does not reduce your FTE, which all those are really favorable.
Thanks. David, Richard had a question about sole proprietors with employees. Can draws for the proprietor compensation qualify as payroll forgiveness?
So first of all, partners are included. If you have a partnership and you pay guaranteed payments to partners are included in the calculation, but they're not included in their health insurance and pension benefits are not included. Sole proprietors have this weird calculation, but essentially their compensation, to the extent that it exceeds the $100,000, is limited to that $15,000 number.
Would you like to expand on this safe harbor question that Taylor had asked earlier? Taylor, did you have some specific questions?
I was just wondering if you could expand on what the safe harbor is, because you mentioned that it could be an alternative to all the tracking and reporting, and I'm not really sure what the qualifications are in order to do that under safe harbor.
Yeah, so what they say, and if you follow through the form, it's really complicated to read, but if you read the guidance, what they basically say is, if you look at your full-time equivalent, and the bottom line is, if your full-time equivalents in February are consistent with your full-time equivalent at June 30th, okay, that's your restoration date. And if they exceed, if at June 30th your full-time equivalent exceed your February 15th full-time equivalent, essentially you can avoid the full-time equivalent calculation altogether because you won't have a reduction. It's the same thing for the pay rate calculation. Now, for the purposes of filling out the form, and I'm assuming your banks are going to require this, the form is, has a very detailed calculation of each, and I think I would prepare it anyway, but you can get a sense of comfort that you're going to not have a reduction related to FTE or pay rate if you restore it by June 30th.
David, what about mileage reimbursement? It's another question from Tony.
Yeah, that's a great question. That hasn't specifically been covered in anything I've seen. However, if for my purposes, if it's related, the problem with mileage is it relates to a lot of things besides just the gasoline. So there is a calculation that the IRS puts out that sort of breaks it out. And you can, probably include that. I just haven't seen final guidance on that. Certainly if they have a gas card and they're driving for the purposes, the example I use is if you have delivery trucks in your business, you would definitely want to include their gas in your utility calculation.
Okay. And Thomas is wondering if contract bookkeeping expenses can be paid with the loan.
No. I mean, they can, but, well, no, they shouldn't be. I wouldn't pay them with the loan. They're not one of the forgivable costs, and they're not specifically detailed in the
And contractors in general.
contractors in general, because what happened, initially they were included, but then the SBA came out and said, because contractors can fill out the loan on their own, can fill out a loan application on their own, the amounts paid to independent contractors are not included.
Okay. And then Rachel had a question about the FTE calculations. Is it okay if the FTEs cover a smaller number of part-time employees working more hours, for example?
I think I'd have to go through the math, but it could, because yes, I mean, if you think about it, and I'm sort of envisioning as we're going, what you do is you take every employee that worked for you, you determine what their FTE is. So if you add more employees, but have a less number of hours worked, then they would, whatever hours worked they had would be included in the FTE calculation. If you had fewer employees, but they worked more hours, you can't exceed 40, but if you get to 40, where you weren't there before, their FTE number would increase. And then when you add them all up, whatever the total is, that's your FTE.
Okay, great. Thanks everyone for keeping the questions rolling, and David for responding to each one. We will collect any other questions that come in, and David has generously in the past helped us prepare a document to send out as a follow-up with an email to this chat. And we also have a tape recording of this webinar that we'll send out to you as well. So in case you have a colleague who might want to benefit from listening to the answers to the questions, we'll do that too. David, thank you again. It was so helpful to have your expertise available to everyone. We really appreciate it, and we know the people on the chat did as well. And this is such a complicated, constantly changing subject, and it's just great to have your advice bringing some clarity to a murky situation. We'll keep at it. Thanks everyone for hanging in there. And thanks to the City of Capitola for co-sponsoring and getting the word out about our chat. We have some others coming up that we wanted to let you know about if you're interested in. We're trying to do these every week, and most of them are Tuesday mornings, but sometimes, like today, we do a different time to accommodate a speaker or an audience. Next week at our regular time on Tuesday mornings at 10, we'll be doing an introduction to Data Share Santa Cruz County, which is a data sharing platform with all kinds of data relevant to subjects that we all are interested in and work on, and try to make a data-driven portrait of our county. So this is a guided tour through it. And if you're interested in that, we would love to have you join us. And then, as I mentioned earlier, we have a shared folder with lots more about the Collective of Results and Evidence-Based Investments, or CORE, which is the umbrella for these chats and lots of other tools and trainings and resources and webinars that you can find there. So we want to thank all of you for spending part of your morning with us. Thanks to David, and we'll be in touch. So keep any last questions coming through the chat, and we'll hope to see you on a future chat. Thanks, everyone.
Thank you.
Bye.